Right now, almost 40 cents of every dollar in your 401k, if you own a standard S&P 500 fund, sits in 10 companies. Not 500 companies. Just 10. And every one of them is either building AI, selling AI chips, or betting everything on AI. You didn't choose this. If you have a 401k, a Roth IRA, or a basic index fund, you already own this exact bet. You own it whether you've ever bought a single tech stock in your life, or never even opened a brokerage account. When people argue online about is AI a bubble, they treat it like a Wall Street problem, something for hedge funds to worry about. It isn't. If this bubble pops, it doesn't just hit Nvidia shareholders. It hits your retirement account, your parents' account, and possibly your job. In the next 15 minutes, I'll break down exactly what's happening, and why smart people on Wall Street are split right down the middle. Most importantly, I'll show you what you can actually do about it before the music stops, so stay with me till the end. That what to do part is genuinely the part that matters most for your money, so don't skip ahead. Let's get into it. Let's set the stage with real numbers, because this conversation gets emotional fast, and I want you grounded in facts first. Global spending on AI is projected to cross $2 trillion worldwide in 2026 alone, an almost unimaginable number. The four biggest tech companies, Microsoft, Amazon, Google, and Meta, are on track to spend roughly $710 billion combined this year. That money goes into AI infrastructure, massive data centers, specialized chips, and entirely new power plants just to run it all. Nvidia, the company making the chips powering most of this boom, pulled in over $215 billion in revenue last fiscal year alone. That's a 65% jump year over year. That's not fake growth, that's real, measurable money changing hands right now, today. But here's the tension: stock valuations have run way ahead of even this genuinely impressive real-world revenue growth we just covered. The S&P 500 is currently trading around 23 times forward earnings, noticeably above its long-term historical average multiple. A longer-term measure called the Shiller-Cape ratio, which smooths earnings over 10 years to strip out noise, has crossed 40. In the entire history of the stock market, that level has only been hit once before, right before the 2000 dot-com crash. Now, before you panic, there's a genuine argument on the other side too, and I want to give it to you fairly. A good finance channel shouldn't just feed you fear for clicks. So let's actually look at both sides of this debate honestly. Here's the bull case: unlike the dot-com companies of 1999, today's AI leaders are actually, genuinely profitable businesses right now. Pets.com never made a single dollar in its life. Nvidia makes billions every quarter. That's a real difference from the dot-com era. It's the strongest argument for why this isn't simply 1999 repeating itself with a new coat of AI-colored paint. The Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla post net profit margins above 25% today. That's almost double the average S&P 500 company's margin. These are not empty hype machines, they're highly profitable businesses. Now here's the bear case: the gap between what's being spent on AI and what's actually being earned back is enormous. Companies pour roughly $400 billion a year into AI infrastructure, but real enterprise revenue from AI products sits around only $100 billion. That's a massive gap between the bet being placed and the actual payout. Wall Street calls this a duration mismatch. Translation: companies are spending as if the payoff is guaranteed and immediate, when in reality it's neither one of those things. Even Google's own CEO, Sundar Pichai, said publicly that no company would be immune if this turns out to be a bubble. That includes Google itself. When the CEOs actually building this technology used the word bubble out loud, that's worth noting. Here's where this stops being an abstract finance debate and becomes personal. Picture your own retirement account while I walk through this. Point 1, your 401k is more concentrated in AI stocks than you probably think, no matter how careful you've been. Back in 2015, the 10 largest S&P 500 companies made up about 19% of the entire index's total value. Today, that number sits between 40 and 45%. 10 companies now control nearly half of America's most watched stock index. Those same 10 companies earn only about 32% of the index's total profits, despite controlling almost half of its value. That gap, between how much of the index they are versus how much profit they actually generate, makes analysts genuinely nervous. Here's the part that catches people off guard: it doesn't matter if you think you've been financially conservative with your choices. If your 401k sits in a target date fund, the default option most employers pick for you, you're still exposed. A target date fund is just a bundle of index funds wearing a friendlier, more reassuring label with a year attached. The concentration doesn't disappear because the fund is named 2050. You inherited this exposure by default, not by choice. Point 2. This isn't just a young person can write it out easily situation. Your age genuinely changes the stakes here. If you're in your 20s or 30s, a market drop isn't the end of the world, you have decades to recover fully. But if you're within 5 to 10 years of retirement, or already retired, this hits you completely, dramatically differently than that. There's a concept called sequence of returns risk. It means if markets crash right as you start withdrawing money, damage becomes permanent. You lock in those losses because you're pulling money out of a shrinking account instead of simply letting it recover naturally. A 30-year-old can wait out a downturn comfortably. A 65-year-old withdrawing monthly income for groceries simply cannot afford to. Point 3. Analysts are already putting real numbers on what a serious AI-driven correction could actually look like for investors. Wall Street strategists, including teams at JPMorgan and Société Générale, estimate a potential S&P 500 drop of 30 to 50%. The AI megacaps themselves could fall even harder in that scenario, potentially 50 to 75% from their eventual peak. Nobody serious calls this outcome imminent or guaranteed. But major banks running these exact numbers tells you it's being taken seriously. Point 4. It's not just your portfolio at risk here, it could genuinely be your paycheck too, depending on your industry. Remember, over $700 billion is being poured into AI infrastructure this year by just 4 companies alone, at massive scale. If enterprise AI revenue doesn't catch up to that spending fast enough, historically, something in the system eventually has to give. That usually means layoffs, hiring freezes, and slower wage growth, especially in tech, but rippling outward into other industries too. So this isn't just a will my stocks go down story. It's a retirement account, job market, and economy story, tangled together. Let's talk history for a second here, because understanding the past gives us real context for what's happening today. In the dot-com crash of 2000, the Nasdaq lost a staggering 78% of its total value in a short span. Companies with no revenue and no real plan to ever profit were trading at billion-dollar valuations purely on hype and momentum. When that bubble finally popped, it took years, for some stocks, over a full decade, to ever recover their value. Today's AI companies are structurally different in one big way: they generate real, verifiable cash flow, right now, today. Nvidia, Microsoft, Google, these aren't concept companies chasing a dream. They generate enormous, provable profits every single quarter. That's a genuine, important difference from 1999. Anyone claiming it's exactly the dot-com bubble again is oversimplifying this situation badly. But here's what still rhymes, even if history isn't repeating exactly the same way it did 25 years ago. Extreme concentration: just like 1999 and 2000, a small handful of stocks are carrying the entire market on their back. Valuation multiples are disconnected from near-term earnings. The CAPE ratio crossing 40 for only the second time ever isn't nothing. There's also a phenomenon called AI washing, companies slapping the word AI onto products or investor decks purely to boost their stock. That's strikingly reminiscent of companies adding .com to their name in 1999 and watching their stock price pop overnight. There's also real retail investor mania. Everyday people are piling into AI-themed ETFs, chasing performance instead of studying fundamentals first. So the honest answer, not the clickbait one, is this: it's not guaranteed to repeat 2000 exactly, but it's not nothing either. It sits somewhere in between, a real technological revolution, wrapped in real speculative excess, on the most concentrated market in decades. So what would actually set this off? Analysts are watching a handful of very specific, concrete trigger scenarios right now. First, a guidance shock. One major hyperscaler suddenly cuts AI spending, or badly misses revenue expectations in an earnings call. That single event could spook the entire sector at once, because these megacap stocks now tend to move together in lockstep. Second, a liquidity shock. Rising interest rates or a credit event could force big investors to sell winners just to raise cash. We saw a small preview of this exact kind of forced unwind back in August 2024, during the yen carry trade panic. Third, regulatory pressure. Antitrust scrutiny on the Magnificent Seven is intensifying right now, on both sides of the Atlantic Ocean. A forced breakup, restricted acquisitions, or new limits on exclusive AI partnerships could change the competitive math almost overnight. Fourth, the monetization gap simply never closing. Spending stays high, quarter after quarter, while promised productivity gains keep failing to show up. Eventually, investors stop giving management the benefit of the doubt. None of these are predictions, they're scenarios risk teams model today. This is the part one actually wants you to remember, because fear without action is really just anxiety with extra steps. Step 1. Actually check what you own. Most people have never once looked at how concentrated their own 401k truly is. Log into your account and look at the top 10 holdings listed there. You might genuinely be surprised by what you see. If you're in a plain S&P 500 fund or target date fund, you're likely 30 to 40% exposed to AI megacaps already. Step 2. Consider diversifying away from pure market cap weighting, which naturally overweights whatever has already gone up the most recently. An equal-weighted fund, by contrast, spreads your money evenly across all 500 companies instead of doubling down on one theme. This isn't about abandoning stocks entirely. It's about not accidentally being all in on a single concentrated theme without realizing it. Step 3. Match your risk to your actual timeline. If retirement is decades away, a correction is genuinely survivable long-term. Historically, the market has always eventually recovered, given enough time to do so. Time is the young investor's biggest advantage. If you're within 5 to 10 years of retirement, this is the moment to talk to a fee-only fiduciary advisor seriously. A fiduciary is legally required to put your interests first, unlike someone earning commission on whatever product they happen to sell you. Ask about rebalancing and building a cash or short-term treasury buffer covering a few years of your expected living expenses. That buffer alone can protect you from being forced to sell stocks at exactly the worst possible moment in a downturn. Step 4. Don't try to time a complete exit. Nobody, not JPMorgan, not Goldman Sachs, not any YouTuber, knows exactly when. The goal isn't predicting the top and selling everything you own. The goal is making sure a pop doesn't wreck your entire plan. AI is probably the most genuinely transformative technology of our lifetimes. That part of the story really isn't hype at all. But the technology is real and the stock prices are rational are two completely different questions worth separating clearly in your head. Right now, a lot of people are answering the second question based purely on how they feel about the first one. Your retirement account doesn't care about the hype cycle. It only cares about what's actually sitting inside it, right now. So today, go check. Log in, look at your top 10 holdings, and see exactly how exposed you really are. If this video helped you understand your own exposure, hit subscribe. I break down stories exactly like this one every single week. No fear-mongering, just real numbers and what to actually do with them for your own money and your own future. Drop a comment and let me know, did you check your 401k yet? What did you find in there? I read every one. See you in the next video.